Traders, do you really know what a pullback is? A perfect pullback in the ComLucro framework follows very specific rules. First, it only happens after a confirmed break of structure with a clear candle close, not just a wick. Second, the pullback retraces toward the most recent higher low in an uptrend or the most recent lower high in a downtrend without breaking and closing beyond that level. Third, the pullback reacts at a meaningful location, usually a demand or supply zone that originated the impulse, ideally one that includes a fair value gap. Fourth, the retracement must have enough depth. It needs to reach at least the 38.2% Fibonacci retracement of the prior impulse. And finally, if price only leaves wicks, grabs liquidity, or breaks and closes beyond structure, it is not a pullback. It is either liquidity or a potential change of character. That is what defines a 3-star pullback in the ComLucro framework. So in today's video, in the Pullbacks chapter of our Smart Money Concepts course, we're going to break down how pullbacks actually form inside market structure. You will learn how to identify a valid pullback in clean and imperfect trends, how to separate pullbacks from liquidity grabs and false reversals, and how to use structure, candle closes, and retracement depth to stay aligned with the dominant direction. We'll also explain why many pullbacks fail, how fair value gaps and liquidity influence retracements, and how to avoid entering against the trend by misreading structure. With that in mind, let us start by looking at how price behaves in a clean trend and how structure defines a healthy pullback. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Let us get started. When the market is moving in a clean uptrend and price keeps advancing, it consistently respects demand zones and breaks structure to the upside. In classical terms, it prints higher highs and higher lows. Inside this type of trend, what we call a pullback is simply a retracement of price before continuation. On the ComLucro channel, pullback and retracement mean the same thing. Every time a structural level is broken, a fresh demand zone is formed, and that zone often becomes the reference area where the pullback reacts. A break of structure is only considered valid when a candle clearly breaks through and closes above the level. A wick extending above the high shows that buyers managed to push price higher, but it also signals rejection back into the range. From a pullback perspective, this type of move often represents liquidity being taken, not a real retracement. Many traders confuse these wicks and liquidity grabs with pullbacks, but they are not the same thing. When price produces another break with a strong full-bodied candle, this confirms a valid breakout. At that moment, we can define this level as the most recent higher low. This higher low is the key reference for identifying a healthy pullback. As long as price holds above this area, the bullish bias remains intact, and the retracement is considered corrective. When price pulls back into this zone and respects it, we classify that move as a valid pullback. If a clear reversal pattern appears, it may be reasonable to look for a short trade targeting this demand zone, since it still functions as solid support. A change in character takes place when price breaks and closes below this higher low. When that happens, the move is no longer a pullback or a retracement. Buyer control is being challenged, and the market may be shifting structure into a potential downtrend. The same logic applies in a bearish environment. When the market is in a clean downtrend and price keeps pushing lower, it respects supply zones and breaks structure to the downside, forming lower lows and lower highs. In this context, pullbacks or retracements appear as temporary moves into supply before continuation. Each time a structural level is broken to the downside, a new supply zone is formed. As long as price stays below this swing high, the downtrend remains valid, and retracements are treated as pullbacks, not reversals. Here is an example showing recent price action on the euro-dollar 1-hour chart. You can observe how price respects lower highs and repeatedly breaks structure to the downside, forming a textbook downtrend. These movements clearly show how pullbacks form inside structure and why structure levels and swing points matter. If you study a chart and struggle to determine who is in control, it is often better to skip that pair. Markets rarely move in a perfect way. In less ideal trending conditions, price may break below higher lows and still continue upward. These moves often mislead traders into believing the uptrend has ended, when in reality, price is only retracing. Very often, these false signals occur to collect liquidity or to mitigate fair value gap zones, not to reverse the trend. Here's an example of how an imperfect trending market can appear. At first glance, price may look messy and directionless. But in this video, we will show you how to read these conditions through the lens of pullbacks. In imperfect trends, the key is not reacting to every small break, but understanding which movements are real pullbacks and which ones are just noise. Many short-term reversals in these conditions are temporary and often exist only to trigger stop losses or collect liquidity from retail traders. The first concept we will cover is how to separate major swings from minor swings, because this distinction is essential to identify valid pullbacks. Not every swing high or swing low defines a retracement. In an uptrend, major swing lows are the levels that matter, because they are the zones from which breaks of structure originate. This level represents the starting point of the impulsive move after a previous high is taken, and it defines where a pullback is allowed to retrace without invalidating the trend. A change of character happens when price breaks and closes below this specific level. When that occurs, the move is no longer a pullback or a retracement. The remaining swing lows are classified as minor, and a break below them does not signal a genuine reversal. These minor breaks often happen during pullbacks and should not be mistaken for a change in direction. Now here is a key point to understand. A level can only be classified as a major swing after a valid break of structure has occurred. Until that happens, a retracement cannot be properly defined. This level represents the highest price recently traded, and a break of structure is only valid when price clearly moves through it with conviction. Only after that confirmation can we label a swing as major. For that reason, this level becomes the reference point for pullbacks, while the remaining swings are treated as minor reactions. A break below a minor swing low still signals a temporary loss of bullish strength, but not a reversal. In some situations, such as a reversal liquidity sweep coming from a higher time frame key level, a short trade may be considered targeting the major swing low. This is because price often reacts when it taps into that level. However, this type of trade goes against the primary trend and carries higher risk, which is why most of the time these moves are better understood as part of a pullback rather than a trend change. Now, let us review the bearish case. The same logic applies when identifying pullbacks in downtrends. Separating major swings from minor ones allows you to correctly define direction and avoid misreading retracements as reversals. After price breaks the lowest recently traded level, the starting point of that impulsive move becomes the major high, and pullbacks are then measured from that level. On the euro-dollar 1-hour chart, we can observe 1, 2, and 3 moves breaking below this low, establishing a downtrend. The origin of this impulsive move is defined as the major high. As long as price stays below this level, the market remains bearish, and any move back toward it is treated as a pullback, not a reversal. Let us continue the process of identifying major and minor swings, because this is critical to reading pullbacks correctly. When price breaks structure and forms a new low, the level where that break of structure started becomes the new major swing. This level defines the maximum area where a pullback can retrace without invalidating the trend. If price only leaves a wick below the recent low, this is not a valid break of structure. It is classified as a minor swing. These types of moves happen frequently during pullbacks and should not be mistaken for structural shifts. A move above a minor swing high does not signal a change of character. It is often just part of the retracement. A real reversal only occurs when price breaks and closes above the major high. Until that happens, all retracements toward structure are treated as pullbacks inside the trend. We continue marking major and minor swing highs until a valid change of character appears. Only at that point can we say that the pullback has failed and that the market may be transitioning into a new directional bias. In this example, we see what appears to be a change of character defined by two clear wicks breaking above the last major swing high. This is where many traders misread pullbacks as reversals. However, it's important to emphasize that a change of character is only valid when either multiple wicks clearly exceed the level or when a candle decisively closes beyond it, followed by a confirmed break of structure. Without that sequence, the move is often just liquidity taken during a pullback. Another factor that strengthens the validity of a true change of character is when price breaks through the last two swings, not just one. If this does not happen, as in this case, the move is classified as a fake change of character and the prior trend remains intact. This was the first criterion for defining a major swing, the level that becomes the origin of a break of structure. The same logic applies in reverse for bullish scenarios. There are two additional criteria that help us identify major swings and confirm whether a retracement is a valid pullback or the beginning of a real reversal. The second criterion is the fair value gap. In the ComLucro framework, fair value gaps help us determine the quality of a pullback. A bullish fair value gap represents a buy-side imbalance, where buying pressure clearly exceeds selling pressure, often linked to institutional activity. When a pullback retraces into a demand zone that created a fair value gap, we expect a reaction, because price is rebalancing an imbalance, not reversing the trend. For this reason, demand zones that include fair value gaps are treated as major reference points for pullbacks, while zones without imbalances are considered minor. When price breaks below a major swing that created an imbalance, this signals a meaningful shift in momentum. At that point, the move is no longer a pullback or a retracement, and it may point to a potential reversal. The same logic applies in bearish scenarios, where pullbacks react into supply zones that contain imbalances. Here we have three price examples. In the first one, there is no break of structure and no imbalance. This level is classified as a minor swing, and any retracement around it is considered weak. A break below this level does not signal a change in momentum or a reversal. In the second example, we see the origin of the breakout, but there is no imbalance. For that reason, it is considered a major swing, but with lower importance. Pullbacks into this type of level can still react, but they carry less probability. In the third example, the level is both the origin of the breakout and the source of an imbalance. This makes it a strong reference for pullbacks, because price is likely to react when it retraces into this area. Up to this point, we have covered two criteria that help us evaluate whether a retracement is a valid pullback or just noise. Before moving into the third and final criterion, let us look at a practical trading idea. Here we have a major swing low that initiated a break of structure. We also see another swing that created an imbalance. Even though this level did not cause a breakout, it is still classified as a strong reference for pullbacks. When price retraces back into this area, we expect a reaction. If price breaks below it, that signals bearish momentum and the pullback has failed. This situation often appears when price taps into a key level from a higher time frame. At this point, short entries can be considered inside this inverse fair value gap area, targeting the major swing low, since it continues to act as a strong structural reference. In this context, the move into the imbalance is read as a pullback, not as an immediate reversal. Now let us move to the third and final criterion that helps us define a valid pullback: the depth of the retracement. In the ComLucro framework, pullback and retracement mean the same thing. Consider this example of an upward impulsive leg. After the impulse, price forms two retracement candles, but this pullback does not reach the 38.2% Fibonacci retracement level. Because this minimum depth is not achieved, this retracement is considered invalid. As a result, this move is not classified as a real pullback. Instead of being treated as an impulse followed by a correction, the next push higher is read as a continuation of the same impulsive leg. In other words, what looks like a pullback on the chart is actually just part of the impulse, not a completed retracement. This leads us to a key rule in the ComLucro framework. For a pullback or retracement to define a valid swing and separate impulsive legs, it must reach at least the 38.2% Fibonacci retracement of the prior impulse. If this condition is not met, the move is treated as one continuous impulse and cannot be used to define a major swing or a valid pullback. Now take a look at these examples. In the first case, none of the pullback criteria are present, so this level is classified as a minor swing. Any retracement around this area is considered weak and unreliable. In the second case, we have a confirmed break of structure and a valid retracement that reaches at least the 38.2% level. But there is no imbalance. For that reason, this level qualifies as a valid pullback reference, but only with 2 out of 3 criteria met. In the next example, we see an imbalance and a valid retracement to 38.2% or more, but there is no confirmed break of structure. This is also treated as a 2-star pullback because one of the core conditions is missing. In the final example, all 3 conditions are present. The swing created an imbalance, broke structure, and showed a proper retracement. This is what we classify as a 3-star pullback, the highest quality pullback in the ComLucro framework. When price breaks and closes below this low, the pullback has failed. That break confirms a valid change of character, signaling a true shift in market direction and momentum. Up to this point, we've shown how to identify valid pullbacks and why not every retracement or break leads to a real reversal. Liquidity sweeps and fair value gap mitigation often distort price action and invalidate what appears to be a change of character. When a major swing sits inside a liquidity area, a break may only be a stop hunt, with smart money sweeping liquidity before continuing the trend. The same applies to fair value gaps. In many cases, price breaks structure only to rebalance an imbalance, not to reverse the market. Before we wrap up, take a moment to reflect on why understanding structure matters so much, especially in imperfect trending markets. Major and minor swings, fake breaks of structure, and false changes of character directly affect how you identify pullbacks and retracements without being misled. The clearer your understanding of how price reacts around structure, liquidity, and imbalances, the easier it becomes to stay patient, treat retracements as pullbacks, and use them as part of your success. And remain aligned with the true trend. But structure alone is not enough. To apply pullback concepts consistently, you must also understand how liquidity behaves inside market structure. That is why, before we finish, we want to show you a short clip from our Smart Money Concepts course. In this segment, you will see how internal and external liquidity explain fake changes of character, fake breaks of structure, and why price often violates structure during retracements before continuing. Let us take a look. Within the concept of liquidity zones, there are two main types: internal liquidity and external liquidity. Internal liquidity, also known as fair value gaps, FVG, refers to areas within the current price structure. These gaps occur when there is a significant difference between the closing of one candle and the opening of the next, resulting in a liquidity void. These areas are important because large market players tend to fill these gaps, creating trading opportunities to capture movements back to fair value. External liquidity refers to zones outside the current price structure, usually found at previous swing highs and lows. These are the areas where many retail traders place their stop-loss orders. For instance, at a swing high, stop losses often sit just above the level, creating a pool of liquidity that large market participants may target before reversing price direction. In practice, price tends to move between buy-side and sell-side liquidity, seeking these clusters of orders to generate movement and volatility. Recognizing how liquidity flows between these zones helps traders anticipate where price might react and refine their entries, exits, and overall strategy. That clip reinforces a key idea. Consistency does not come from predicting every swing, but from understanding context. Traders who can recognize fake pullbacks, fake changes of character, fake breaks of structure, and liquidity grabs, and still stay disciplined with their plan, are the ones who turn market structure and pullback concepts into stable, long-term performance. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.